Hey folks, FSRA comes down hard on the largest mortgage broker in London, Ontario. The City of Toronto needs $26 billion for infrastructure, and all the banks predicted rates would come down, and they haven't. We're going to drill down on all this stuff and more on episode 181 of our show that we're going to rename Ruffled Feathers. How do you like that? I'm Vince Gaetano. Folks, if you haven't already subscribed to the YouTube channel OwlMortgage, please do so. We got another episode dropping on Monday with 7-time TEDx speaker Chris Cummings. I'm really excited about this one. It was a really good chat. I think you're going to enjoy it, so look out for that. And you could also listen to the Wise Old Owl podcast on Spotify and Apple Podcasts. So let's get right into it. So FSRA comes down hard. FSRA is the Financial Service Regulatory Authority of Ontario. They are the regulator that manages and regulates the mortgage brokers in Ontario. They came down hard on one of the largest mortgage brokers in the province. They're the largest in London, Ontario. Bill Hanson and Forest City Funding got hammered hard recently. Actually, the notice was posted this week. The shop did about $2.4 billion in 2022. They have over 300 agents, and they were fined $110,000 on 11 items of $10,000 each for false deception information regarding the arrangement of mortgages. They were also fined for false and deceptive info regarding gifted down payments, and also misrepresentation of the mortgage payment. So basically what happened was this brokerage arranged first mortgages and also was involved in arranging second mortgages to take out what was presented as gifted down payment, which is a big no-no. And the regulator came down really hard in their audit of their books in 2022 and 2023. And after notifying them and looking for compliance remedies, they caught it again the year after. So this is something that is an issue. It causes problems in the marketplace because it gives people the opportunity to buy homes that probably shouldn't, and they don't qualify. This information was misrepresented to the lenders, and the lenders aren't going to have any of it. It's very, very important that people understand that OSFI has guidelines, and there cannot be any mortgages registered beyond 80% loan to value when people qualify under conventional mortgages. And if it's an alternative type mortgage where it's a non-conforming type mortgage, there can't be any secondary financing registered after 65% loan to value. So when a broker is doing both firsts and seconds and knowingly doing so, the hammer's going to come down, and hats off to FSRA for doing their work and trying to combat mortgage fraud in Ontario. Hopefully this is a sign of things to come, and we're going to see more of it. Mortgage fraud does create inflation in the marketplace. When you have a group of people that are fraudulently securing mortgages that shouldn't be, they're in the market driving interest in property and inflating prices in bidding wars and stuff like that. So hats off to FSRA. And the fines are $110,000, as I said, suspension for a year, and this principal broker cannot act as a principal broker for the next 3 years. So it's pretty much sayonara. Like, this is an interesting situation, all published on the FSRA website if anybody wants to read it. But it's pretty damning. Listen. All the big banks have been predicting rates have been coming down. So I came across a big chart that was posted on X, formerly Twitter, about what some of the predictions were back in January 2023 by the big banks and where we should be by the midpoint of 2024. So just a recap. So back in January 2023, that's about 17 months ago, TD Bank predicted that as of the midpoint of 2024, which we're just a month and a half away, really, we should be seeing the Bank of Canada overnight rate be at 2.75%. We're still at 5. CIBC called for 3.5%. BMO, they weren't able to find what they predicted for mid-2024, but they did say we'd be at 3.88 by the end of 2024. Scotia was at 3% and RBC at 3.5%. Fast forward 12 months, they made a rate prediction in December 2023. And TD said that by the end of the year, we're going to be at 3.5%. They revised it, supposedly upwards. CIBC, 3.5%, and the other three big five suggested we'd be at 4%. Still a bit of hope. But they've now revised in May 2024 where they think we're going to be at the end of June. So end of quarter 2, 2024. So TD is predicting we're going to be at 5. No change. Nothing's going to happen. CIBC, BMO, and RBC think we're going to see a quarter point in June, and Scotia still thinks it'll be flat and we're going to still be at 5. So these financial institutions spend a hell of a lot of money, like millions on economists, on research of all the data that they collect. What the fuck did they miss? What did they miss? Like all the data points that are out there, how can they be off this much? How can they not see that productivity was going down? How can they not see that interest rates were going to start playing havoc? And there's, a lag before things start to break. Now, I'm no economist, but I'm in the weeds. And I see what happens every day as people come in here looking for help to deal with their mortgage renewals, deal with their financing and their budgets. And we're seeing a lot of pain out there. And we're showing a lot of empathy and understanding as to what's to come, because we do believe that it's going to take a while before rates come down. Now, I did make a prediction on the show and on other shows, Revealing Real Estate with Nick Opadesano back in December, and I predicted that we're going to be closer to 5 at the end of this year than 4. And so far, I'm looking pretty good. Now, I'm not going to toot my horn because I hope rates do come down. But the reality is this government continues to spend. They seem to be like drunken sailors on that front. And there seems to be no eagerness to tighten the belts. None at all. And it's going to get ugly, and it's going to take a while for things to get back to normal. So, guys, I don't know. It's still going to be pretty painful, and we're starting to see elevated levels of credit relative to available limits on credit bureaus. We're seeing more and more people borrow more on credit. They're starting to hit that 80% mark of available credit. People are going to start running out, and folks that are renting are hurting more than those that have homes. So we're starting to see things crack and break. And we're starting to see layoffs. We're starting to see a lot of businesses and folks go insolvent. We're going to talk a little bit about that on one of the episodes with Doug Hoyes of Hoyes, Michaels and Associates. He's a licensed insolvency trustee. That's coming out in a couple weeks. We are going to see an elevated level of people starting to struggle because their disposable income is being It's shrinking at an alarming rate, and people need to understand how tough that's going to be. Now, folks, I want to talk a little bit about the City of Toronto. They want $26 billion in infrastructure. They're short $26 billion in the city, and they're looking for the province and the federal government to help out with infrastructure. They need to keep this city going, and it's breaking down. They need to improve services and whatnot. And the reality is, I think this council needs to start cutting things. I think they need to start looking at how to curb their spending and get rid of a lot of these pet projects. There are a lot of projects out there that do no good. There's bullards all over the city, which is just slowing things down to a crawl. It is starting to get really, really concerning about how the city's running it. They don't know what they're doing. Honest to God, I really believe they're just trying to slow everything to a crawl and trying to just stunt innovation, productivity, and any type of building. Like, nothing's getting built. The City of Toronto's permit department's in chaos. They're taking double the amount of time it takes for permits, and there's less of them. So it makes no sense. Everybody's still working from home. We got unions complaining that public service shouldn't be working 3 days in the office. Going from 2 to 3 is a big problem. Like, I'm not trying to stir the pot here, but guys, let's try to work this through and work together. We got to be more efficient. We got to have some purpose. We have to get things done. And by restricting people from getting around the city is not the way to do it. Like, it is becoming a bit of a gong show. And we need people at City Hall to start making some better decisions, because it's only going to get worse this summer. Like, if you want more people to use transit, make it reliable. It can't be down every weekend. It can't be always under construction. Like, it's getting to the point where it's laughable. It's becoming just a comedy show. So get to your councillors and start demanding more accountability, because it's getting ridiculous. I don't mean to go on this rant, but it's just crazy. I want to talk a little bit about something that's happening more and more, and that's marital breakups. Unfortunately, folks have to go their separate ways, and we get a lot of folks approaching us looking for help to buy out a spouse or whatever the case may be. And if there's one thing I could strongly recommend, is try to negotiate a settlement and get a separation agreement in place before you seek out financing. It's so important that people understand that you have to get this agreement in place in order for things to go through smoothly. A lot of lenders will not even process a refinance for this purpose unless there's an agreement in place and there's an understanding of what everybody is going to get. What ends up happening when you don't have a separation agreement is all the work is done and it stalls and gets postponed at closing because the other party didn't agree to the amount that they're getting and wasn't fully versed on all the details, costs, and whatnot. So I strongly encourage people to always identify all the details in a separation agreement. There are some great mediation services and arbitrators that are out there that can offer some preliminary services before you get to lawyers and whatnot. It is cheaper, they're unbiased, they try to walk you through what everybody is entitled to, and then you kind of come to a resolution. And always remember that you have to identify what the dissolution date is, so that date of separation. I had a case just recently where one person was living in the home for a period of 5 years because they were still in an old mortgage and they didn't want to break it and incur a penalty. So they've postponed the refinance till maturity, almost 5 years. They have to now identify when the actual date was. And 2019 was a long time ago. They have to evaluate the date of separation as in 2019. So they need a value that goes back in time. And those have to be professionally done by an AACI or CRA appraiser. And they're a little bit more expensive because there's a lot more work when you go back in time to assess values and whatnot. So just be aware that there are processes. If you do need some assistance in this regard, we've been doing this a long time and understand how difficult and stressful it is. Trying to qualify for a mortgage on your own to buy out the other party is becoming a lot harder because of the stress test and qualifying rules. So if you are somebody that is going through this and you need some guidance and some help, please reach out to our team. We're happy to help and walk you through the process. Got a really good note and email this week from a tenant that we serve. As most of you know, we run a property management company. It's called RPM Wealth Builders. We work with investors to manage their properties. And we got a great email from one of the tenants, Armando, who's our property manager. He goes out and does site visits to properties that we take on and manage for them. And the duty of care that we have for all our tenants is, I think, one of the best in the marketplace. So Armando set up an appointment, went in, provided a fire extinguisher to the units, changed the batteries in the smoke detectors, and had to replace a carbon monoxide detector. And that tenant had been there quite some time, and those things were never done. So she was very, very appreciative of the fact that our duty of care was to protect her and keep her safe. And it was nice to see that there's some positivity that comes out of these visits. Our whole idea is to make sure they enjoy the unit. We want them to enjoy it as best they can, and we also want them to be in a safe environment. And we're going to make sure we uphold those core values to do so, so that way we have a very fruitful relationship between the landlord and the tenant, being that property manager that tries to make a cohesive environment even better. So I want to share that with you. We're going to go into some questions. So we're going to go into the hockey helmet, tighten the chin strap, and let's get right into it. What are some situations where borrowers might consider opting for a private mortgage instead of a conventional one? Private mortgages tend to be short-term solutions to requiring funds. Okay, I call them bridges or band-aids, and usually they come into play when there's a disruption or an unexpected situation. We deal with a lot of folks that are in between jobs, have had an emergency, or they've had an illness in the family that's reduced their income capacity temporarily, and they need some additional funds. We always have to understand what the exit strategy is and share the risks that that private lender may not necessarily renew their mortgage at the end of the term. Private mortgages traditionally are one-year terms, okay? And at the end of that one-year term, there is no guarantee that a renewal will be offered if you're not dealing with someone who is experienced and has the best interest of that borrower in mind and matching them up with the right private lender, knowing that they have the capacity to offer renewals if that situation does occur. So what we're seeing is folks in very low interest rates not wanting to renew. So if they're still in that 5-year term at 249 or 269, they don't want to break it because they got a year and a half left and they only need a few hundred, 50, 60,000 a private. Doesn't make sense to break that mortgage on a larger first to access 40, 50, 60 grand. We're seeing that come up. We're seeing a lot of self-employed people who don't have the capacity to qualify for an A mortgage or an Alt-A mortgage move into the private space temporarily. We're seeing folks that can't sell and have bought. And usually when you have two sales that don't match up, you get a traditional bridge at a bank. If you don't have the sale yet, but there's still equity, private lending does come up in those situations that provide that solution for those folks. But there's many more situations that come up, but mostly they have to be in temporary nature. And there's also construction loans. People need financing to complete renovations, do repurposing projects, which is becoming quite popular, going from 1 unit to 4 units in certain parts of the province that allow it as of right. We're seeing a lot of those projects as well. So hopefully that helps. Can you share some tips for improving credit scores and financial health to qualify for better mortgage terms? First of all, the credit score is only one component in the qualifying criteria for a mortgage. There's a lot of emphasis on income, which the stress test and qualifying rate makes a priority, and down payment. As far as credit, you do need to be in that upper echelon of 680 to 700 beacon score level to make sure you're in the A space, although there are exceptions in that 640 range, but you want to be in the high sixes into the sevens. In order to do that, you got to make sure that your utilization rates are low. What that means is if you're carrying limits of $10,000 on your credit card, for example, you don't want to be carrying balances at over 80% of that available credit. So if you're carrying balances of over 80% on those credit cards, your utilization rate is higher than normal. If you're paying things off every month, you're going to get a better credit score. If you don't have a lot of trades, that's also helpful. You don't want to have a lot of trades where you're using up balances, you're not paying it off, and you want to make sure you're paying things on time. So it's important, if your bank and credit card company does offer you an auto pay feature, take advantage of it so you could have your payments made on time just in case you forget to make a payment because of a busy schedule or you're on vacation or whatever the case is. Put it on auto pay if you can. Those are a couple things, and we could get into that on another episode where I'll cover the whole 5 components of the credit score and go into more detail. So thank you very much. How do you assist self-employed individuals or freelancers in securing mortgage financing? Business for self and self-employed folks are one thing that we specialize in. We deal with a lot of self-employed people in the trades, people that are freelance consultants, don't have consistent income flows, but they do make their money. And what we do is we deal with specific lenders, especially in the Alt-A space, that love self-employed people. I've always said that self-employed people are probably the most versatile because they have the finger on the pulse of what's going on in the economy, and they sense it first. Whereas salary people, they're just getting their paycheck every 2 weeks. It's same old, same old. They're not really in tune with what's going on in the economy. Whereas people that are self-employed do. You're seeing trades starting to see things slow down. They get concerned and they act accordingly. They're very prudent with their money and they go into protection mode. So, these are folks that we try to match up with lenders that understand them, and we do so by looking at the full picture. We collect 12 months worth of bank statements. We go through their income flow on a gross level to show that there's activity. We net out their expenses and try to identify what their cash flow is like. Adding in, certain expenses like car expenses and mobile phone, and if they're writing off a portion of their house, we add that back in to try to come to a solution. But there's many ways to do that. We take our time with self-employed people, and we love them. So if you are in the trades, you are a freelancer, you are in the self-employed bucket, we'd love to help you out and give you a hand. What is the advantage of the first home savings account? Actually, this question seems to come up quite a bit. I think we just had this not too long ago. The first savings account, I think, is a pretty good tool because it's almost as beneficial as an RSP, if not better, because it's non-repayable. So you can contribute up to $8,000 a year to a maximum of $40,000 into a first home savings account, and you can deduct that contribution from your income, which will trigger a tax refund, depending on what your tax rate is. And those funds can accumulate up to 15 years for you to then use to purchase your home. It's something that came out just recently by the federal government. I think it's a great opportunity for folks to save up and take advantage of that tax return to contribute to an RRSP and then use the RSP homebuyers plan as a secondary tool to help you buy a home. So when used in conjunction, you could get quite the return on that initial $8,000 put into your first home savings account that could accelerate your savings. So just think of this. You could contribute $8,000 into your first home savings account, get a 30% tax refund, which would be $2,400, and put that $2,400 into your RRSP, which is tax deductible, and generates a further tax refund of 30%, which would be another $720. So you could get a $2,400 lift into your RSP plus a $720 refund from your RRSP in the second year, which accumulating assets for you, driving that savings up for that home down the road. Now, everybody says, well, Vince, what's $8,000 or $40,000 going to do in this marketplace? It's a start. It helps you save. And that refund and accelerant gets you to where you need to be faster. It may take you 5, 7, 10 years, but it's going to help. So take advantage of these tools if you have the ability to do it and you're in the market to buy a home down the road. Folks, that's it for today. I want to thank you again. Please subscribe, like, share the new podcast that's come out. It's on YouTube at OwlMortgage and on Spotify and Apple Podcast at the Wise Old Owl Podcast. Thanks for tuning in. Take care and enjoy the weather.